Morning, everyone. Welcome to the second day of the SALT iConnections Asia Conference. Certainly hope everyone had a sort of enjoyable day yesterday. Lots of conversations, meetings sort of occurring throughout the day. My name is Eldridge. I'm from Broadridge. I run our sales operations throughout Asia. And to my left here, I have Boon Chye Loh. Boon Chye is the CEO of the Singapore Stock Exchange. So welcome today, Boon Chye.
Thank you, Kurt. I'm glad to be here.
So it's wonderful to have you here. So really today, what we've been asked to sort of give the conference an overview really is the growth of the capital markets in Asia. There's always a lot of interest around the growth story of Asia, et cetera, and how people can invest into that and the asset allocation across that as such. So I guess, what I'd like to start with is, I think as we discussed, we'll start a little bit of a higher level sort of number of questions or conversations really around sort of where are you seeing that sort of top level growth in Asia? What's the exchange experience locally? And also sort of what are you seeing throughout the region as well?
Sure, thank you. And good morning. I'm glad to be here. Obviously, in the last 18 months, lots have gone on in the macro environment. But if I look back in the last 10 years, there has been significant macroeconomic shift. If you look at Asia itself, in the last 10 years, the share of global GDP has grown from something like 35% to right now 45%, probably is forecast to grow to even half of world's GDP by 2030. On the other hand, Europe and US combined, the share of global GDP is only 36%. No doubt that has been a result of the rise of China and in more recent years, the growth of India. But it is more than China and India. We also have Southeast Asia, and with the regional comprehensive economic partnership, which now comprises 10 ASEAN countries plus another 5, Japan, Korea, China, Australia, and New Zealand, ASEAN could really be one of the largest trading bloc in the years to come. So lots, I would say, in terms of the shift in macroeconomic landscape. And there's obviously been talk about deglobalization. I think it's probably in this part of the world, maybe a less globalized world. I think countries will continue to still have to compete. They will have to find a sweet spot. There may be a rewiring of the supply chain, but you have a region that is really more than half the world's population, growing and young population, greater adoption of digitalization, and Asia is right in the center of global growth. The forecast for China in 24 is still going to be in the 4.5% to 5%. And if you look at China last year versus 2020 in 2000, whether you look at in RMB or in US dollars, the economy has grown 12 to 16 times. So growing at 4.5% to 5% still creates lots of opportunity. That said, I would mention that the region is diverse. It's not one singular block. It has idiosyncratic risk opportunities and thereby a diversified approach, country, granular, bottoms-up sector companies, I think will create opportunities for investors.
Okay, I mean, you talk about the diversity and a little bit of the history, and I do think that's important that people do understand. It is quite a large and diverse organization. And, as we were talking previously, there's been a couple of inflection points across the capital markets business and investment profiles over the last sort of 35 years. And if you look at it, as we were discussing earlier, you had that sort of financial crisis in '97, you had the GFC, and now we've sort of coming out of COVID as another crisis point. where do you think the difference is for Asia now as opposed to sort of those last 2 points of inflections that we had in the market?
Yeah, so I think there's still a view out there that whenever you have a strong dollar, whenever global rates, in particular US rates, are rising, there is a greater risk of underperformance in EM and Asia included. And today, China occupies or constitutes almost 45% of the EM composition. But I think the fabric of the Asian economies today versus what it was 25, 26 years ago, back at the onset of the Asian financial crisis, are quite different. Economies are more diversified, they're more resilient, companies are larger, they're bigger, there have been growth of more SMEs, the banking balance sheets are stronger, the financial system in the region are more interrelated, which means there is that financial safety net in some way because of the interconnectedness amongst the various countries to the financial system. And you also have the rise of retail. There are more issuers, there are more investors. There is also the adoption of digital assets. So I think even in the last 18 months, where obviously as the Asian economies and the monetary policy adjust itself with inflation and where the US rates were headed, I think we're at a place where, as I said earlier, the region is very diverse. Each market could offer different opportunities even in that kind of a scenario. And many of you are investors, I presume, in this part of the world. You will have seen and hear Vietnam being one of the China plus one strategy in terms of the rewiring of the supply chain. Big growth in Indonesia. 5, 6 years ago, there was probably only less than 10 unicorns in this part of the world. Today, we have about 60. So there's lots of growth in this part of the world.
Yeah, look, we've been seeing that with some of our research as well. So we do a lot of work around sort of where the fund flows are going. It is sort of post after it's happened, so we do a lot of work researching with sort of fund managers, and we are definitely seeing growth into those emerging markets that you've touched on. India seems to be really attracting a lot of sort of the foreign funds coming in, and you made a pretty significant investment there with Gift City and what you've been able to deliver on the derivative side. So I think that's been a wonderful thing that the exchange has brought forward, and we're also really seeing the resurgence of Japan a little bit. So Japan has sort of been a little sleeping giant for the last 10 to 15 years. As we all know, the Nikkei finally got back above its 1989 highs, so it took 24 years. So there does seem to be a groundswell of sort of interest in that Japanese market again, in Japanese equities. So we're really seeing that flow go across to those. China's probably getting a little bit of the pullback out of that for some general reasons. They're probably facing some headwinds that they're working through, and you're seeing a little bit of rebalancing. So I think, as you said, it is very diverse, and there are lots of opportunities that people could look at and look forward. And that sort of brings us on to sort of the next question, which is a little more targeted around what some of the other exchanges and regulators are doing in region. And the SGX has had a very robust securities lending and stock borrowing platform for sort of decades. And recently we've seen both Malaysia has now sort of expanded its capability for securities lending borrowing. The Philippines has also made a number of announcements. They're moving now into a much wider shorting capabilities within the Philippines exchange. How do you see those sort of regulatory changes supporting the increase of growth and interest in the region as well?
Well, I think it goes way back to 25, 26 years ago, post the Asian financial crisis. Back then, there wasn't really even a fixed income market. It was really a banking market, and it was really with a lot of currency mismatches, as we all know, dollar liability with local currency asset. But since then, there has been the progression and development of a stronger and robust regulatory framework, as you said, whether the stock borrowing and lending program that creates better price discovery. But I would say in the last couple of years, there has been capital markets development. We've seen the rise and emergence of the bond market. We clearly have seen development of the derivatives market, futures and options, structured products. We've also seen the opening of China and India. And for us as an exchange, SGX, given where obviously interest rates are, we've always looking at the region as so diverse with idiosyncratic risk return opportunities. It is important that for investors, a simplified access platform into Asia, where investments into any country could cut across many different asset classes, not just purely in equities. It could be in fixed income, it could be in currencies, and it could be in commodities. In the equity derivatives market today, you could invest almost close to 100% of Asia's GDP via some of the products we have. And in the commodity space, it's no longer just the physical players in there. Iron ore today is a bulk commodities that's traded round the clock. Today, total volume traded is twice the physical market. And screen trading is more than half the volume. And in Asia, the currency can accentuate your equity return positively or negatively.
Yeah.
And thereby, with higher rates too, cost of capital, margin efficiency, I think those are important considerations. You talk about 𝐸𝐿. In July this year, we worked with our partners in the NSE to create the India-Singapore Capital Markets Corridor. It's a high-end technological connectivity between Singapore and India through the GIFT City in the state of Gujarat. It really allows for participants to risk manage and invest in the Indian equity market through the Nifty futures, essentially offering international liquidity pools out of SGX and the domestic investors out of GIFT in the enlarged unified liquidity pool. So lots going on, but I think what will be more interesting is at this level of interest rates, currency becomes more important. And regulatory changes over the years now really means participants have a choice of managing FX risks, no longer just the OTC market. You have the listed derivatives market, and you also have the electronic dark pool.
So, I mean, you touched on sort of GIFT City there, which I think is you know, a great strategy you've taken. Is there any further areas that you're looking to sort of position the SGX as sort of a gateway into further, you know, investment capabilities or possibilities for sort of the asset managers? Because, you know, if you look at it and you touched on regulatory, there's a very strong regulatory support and robust. You know, the MAS is both very robust but also very flexible in what they're looking to sort of allow people to do to help growth. Are there any other areas of sort of interest that you're looking to explore around that with the exchange?
Yes, I think one area of, I think, interest and development that I think could be quite useful is connectivity. And it touches on also the digitalization, whether that's digital assets or not. The markets, in particular within Southeast Asia, they are developing. Some are at a faster rate, some are deeper and broader, and each has its own unique strengths. And the markets could be connected in a format where you could have trading of that via depository receipts, where shares of listed companies on one exchange could be traded on another through receipts, much similar to the GDRs, to the ADR. So that's not quite unique, but it allows for access, in particular for retail, because in some countries the currencies are still not fully comfortable. But I think what is more interesting is, and I think in Broadridge you have that offering too in the DLR, which is, I guess, the digital ledger repo.
Yep.
The shares of many of these companies could still be immobilized in their domestic market, but you could create a smart contract to link the settlement so that the shares could still be in each location in the custody, but it could facilitate the trading and price discovery on a different market.
Yeah, look, we've spent a lot of, thank you for that. We've invested a lot of time and effort around the distributed ledger platform that we've built, and that does bring us on to the second areas we were going to talk about with digital assets. And you have seen a significant uptick probably in the last 6 months around sort of digital assets, et cetera. And there's the significant difference, I think, between what people are calling dematerialization, and really I think what Broadridge is focused on right now is the dematerialization. So taking an existing asset and being able to digitize it, and then being able to, as you said, immobilize it and move that asset from jurisdiction to jurisdiction as needed. If you look at sort of where the future is also coming, so you've got the dematerialization, and then you're now starting to drive forward with more of the native digital. Recently you yourselves did a bond issuance, I think about 12 months ago through the market node platform. The HKMA did one, I think 2 weeks ago. They did a green bond worth about 800 million. HSBC announced last week their digitization of gold. Where does that native digitization strategy start to take hold? And where is that in, I think the interesting thing to try to discuss is where is that inflection point where it moves away from what could be the older system into the newer system? And is that a 3-year journey, a 5-year journey, 10 years? It's an open question there, unfortunately.
Not easy to predict the inflection point, but I would say it's promising. It works. In particular, if you look at DLT, where blockchain is the most common, and the top layer would be the smart contract. I say it's promising because you could create efficiency by shortening the settlement cycle, but at the same time, you could really create a more efficient in terms of process and costs in the asset servicing. So whether that's in the issuance of a security, a structured note, I think that could all come true. But I think what is also interesting is in large parts of Asia, most markets, besides those that are traded on exchanges, are still in the OTC space. And that's where I think through smart contracts and the digital part of the equation, this could really allow democratization of ownership, of fractionalization of these assets. We ourselves have seen some of our brokers today that are offering fractionalization of shares through their platform linking to our matching engine, even though our matching engine would trade standardized blocks. And I could see one potential use cases, and this will be where many will be built on for the inflection point in real estate. Notwithstanding, obviously, higher rates impacting the market. In many parts of Asia, real estate is one where the buyer is committed with the purchase, but before he or she takes delivery, they will have to continuously have a bank financing to pay for that in a progressive payment. That part of that financing could be tokenized in a digital format that could be sold to other owners before the asset is being eventually developed and delivered.
Yeah, look, it gives you the flexibility to allocate risk, and really risk for a lot of financial transactions comes with a reward. So I think that fractionalization and being able to separate that risk out provides sort of a number of aspects. It probably reduces some risk across the system because you've separated that risk amongst sort of more parties. But it also gives an ability for sort of players and market participants that might not have been able to access that sort of a yield to be able to step into some sort of new investment products around that as well. So, anything that has that ability that can be segmented down and then stacked up, I think it's a great thing for the market, gives people a better opportunity to manage their risk, price their risk, and deliver risk. So, I think that's interesting. And then when we touch on some of these new products, I know that, the exchange has made a fairly significant investment in the Climate Impact Exchange. You've now gone live, I think it was about 4 or 5 months ago, with the first parts of carbon credit. How do you feel about that part of the market? And do you see, if you look at, the Asian market with, a lot of the world's factories being in Asia, does carbon credits, a more important factor in Asia? Or do you think that, a carbon credits trading program in Europe has sort of greater value and benefit?
Well, I think Asia will play a crucial role in the transition to a net zero world. Asia will contribute about 50% of greenhouse gas emission. So Asia will have to play its role in the transition to net zero. That said, many parts of Asia in some areas are still without power. So that transition will have to take into account the particular social, economic, dynamic and fabric of each of those markets. And they are sectors where it is the emissions or the sectors is hard to abate, but we can't really wait. Climate change is real, and I think besides a carbon tax or a regulatory regime, I think voluntary carbon markets, carbon credits, is one of the many toolkit that I think industries and companies will have to play their role with. Obviously, first a net zero pathway, a target, a transition, a measurement, and continues to improve. And in areas where it is hard to abate and the technologies are still not quite there, I think voluntary carbon credits will have a role to play. Obviously, we all have to be mindful in the voluntary carbon credit market of the risk of greenwashing. So I think over time, as the standards become more developed, it could be one that could be one of the important toolkit.
Yeah, look, I think what you touched on there is very important to understand what that supply chain looks like.
Yeah.
You can't punish one end of the supply chain because they're generating the carbon that the other end of the supply chain is getting the benefit from, not providing the carbon because you've just shifted it around. So, I agree with you. I think it's going to be a very interesting space to grow in the next sort of 3 to 5 years. And it's an important space for us to look at. If we don't start to address this in a decent time frame, it can be more challenging. So we only have a couple of minutes left. We will talk very briefly about crypto. We've touched on sort of the digital assets, the carbon credits. Bitcoin's gone back above 35,000, so it's back on CNBC quite regularly now. Where do you see an exchange playing a part in this? And looking at sort of the direction that's coming out of sort of the Middle East right now with a very open regulatory framework trying to attract that sort of business into the Middle East. And where do you see that against sort of, Hong Kong and Singapore, who have been quite vocal in supporting those businesses in the past?
Well, the technology underlying that, which is really DLT works, and we talk about the usage of that in the digital assets. But to answer your question specifically around cryptocurrency, I think exchanges, including the Singapore Exchange, I think we are in the environment, in the business of building regulated marketplace with transparency, with clear rules. And I think for some of these markets, if the guardrails are there with proper regulation, I think that could probably extend the participation in a way that exchanges are known for in terms of providing fair, orderly, transparent in the discovery of prices and trading. But until then, there are clearly, obviously, the risks of conflict of interest, whether you're a trading platform at the same time the issuance of the asset. I think these are many areas that I think has yet to be resolved.
It's, it is going to be an interesting ride again, I think, with crypto for the next short period. So it'll be interesting to see how the market evolves around it. And as you've touched on, the infrastructure and the ecosystem around both digital assets, whether they're cryptocurrencies or the work we're doing or the work that some of the banks are doing, how does that ecosystem evolve to support the myriad of services that are required. And I do believe sometimes people, forget that it's not just trading. There's compliance, there's risk, there's funding, there's so many facets behind a trade that an organization needs to understand and be able to manage, rather than, hey, I've got a new crypto that I can trade. One of the last things we were touching about was sort of data. If you speak to a lot of the buy-side community now, with AI coming in, the automatic programmatic trading that's been prevalent for the last sort of 10 to 15 years, they're getting incredibly consumers of that data out of the exchanges and other areas. How do you see that part of the market evolving around sort of what unique data types and formats will be expected?
Well, with AI and the large consumption of data, I think everyone is trying to find the edge in using data. And there's been a lot of work and I think some deployment around alternative data. The question around that is how can exchanges also be part of the ecosystem? Because you're talking about satellite imagery, you're talking about information through social media, you're talking about signals, and also even in alternate data. While latency has been one of the challenges in transmission of data, that could also play a role. I think part of all this is we should not make the costs of data more expensive, because in the end, the overall ecosystem, the trading investment community has to be able to bear that. And I do see exchanges and many market infrastructure over time will make more and more data available. Exchanges, including XGX, today has got certain level of data that we make it available for public consumption.
Yeah, I think with the AI one, it is quite interesting looking at sort of the bias that comes with that data as well. We've released a number of AI solutions. One's Bond ChatGPT that allows you to search bond databases, et cetera, to find the right tenors, the right bond that you're looking for. Could be corporate bonds, federal bonds, et cetera. And what it's really trying to do is reduce that time down of research with people. But I know from working with our team inside Broadridge, the really interesting time was spent with our internal compliance team as well. And again, it's very easy to simply deploy some AI, but you really need to understand what it's doing, what data sets it's interrogating, what you've trained it to do, et cetera. And that's where I do think, as we talk about data sets, that exchanges such as yourselves that have some of those more robust processes built around them are natural places.
Yeah, I'm making those models available over time. Yeah. The data that we'll have to train the models.
Yeah.
Yeah.
Okay. So we're almost finished. Any final thoughts on future of capital markets?
Well, I mean, the world clearly is very uncertain, but I think if you look across Asia, I think for the next 5-10 years, Asia will continue to grow, and there'll be interesting opportunities in this part of the world.
Excellent. Thank you very much,
Thank you.
Chye. Absolutely.
Thank you, everyone.
Appreciate your time
Yeah.
today.